Ganeshram Jayaraman is here, joining us from Spark Capital, all the way from Chennai. Ganesh, thank you so much for your time, talking to you after a long time. I was reading through your reports and you were making a case analyzing the steps being taken to repair the economy, that neither it is, I know you've named the report very interestingly, time for antibodies or antibiotics. What's your analysis of the situation on ground right now?
Good afternoon. Good speaking to you. See, the way we are looking at it is, it's now almost 2 years that we have been cautious, and pretty much every risk that we saw is played out. What do we do now? I think we still believe that we are in an growth moderating phase. Earnings downgrade cycle is here to stay. Even after the June quarter result season is done with, we realize that the street is expecting a very strong second half. For this financial, we don't see that to play out. We still see earnings downgrades to be quite significant, and we also think multiples need to mellow down. It's still aggressive. So expectations front on the ground, challenges will be ahead of us, and we think earnings downgrades, multiples downgrades are here to stay. But having said this, we think on the macro front, which typically means you need to think 6 months ahead of earnings, or maybe even 9 months ahead of earnings, and there we think the worst is over. We think we are beginning to see the first signs of improvement on the macro front, and those means now whether that will percolate into the ground realities in 6 months, 9 months, 12 months, difficult to predict right away. But we are seeing the first signs of things on the macro front improving. What I mean by that is the interest rates are coming down, the bond yields are coming down, the system liquidity is quite immense. Government spend has picked up in July and August, which was a problem pretty much from, say, December till June. July and August, government spend has picked up, and that's something which we are quite positive about. But that's more at the central government. The state government spend is still in the negative territory. So when I look at the overall macro, the fiscal is a bit of a challenge still. The monetary situations have improved, liquidity has improved. So it's something that which will mean that fiscal 21 can be in safer hands than fiscal 20. But 20 will see more downgrades on that low base. Fiscal 21's growth assumptions will also need to get moderated. So which means there are two parts out here. The macro should improve, the micro should deteriorate. That's the way we are looking. So we are not in a hurry to change our defensive portfolio stance. We are staying put with that for now. We are re-looking at pretty much everything. So we need to keep watching for further data. But for now, the defensive mindset still holds.
In fact, Ganesh, I must congratulate you. Last 15-16 months, you have been slightly cautious, and look how the markets actually have behaved. I would like to understand your stock picking stance in a moment, but talking of steps being taken for the repair of the economy, which I would like your thoughts on, my colleague is also gathering some fresh steps which could be announced by the government, and here she is to talk about the real estate sector could be on government's radar now.
Finance Minister Nirmala Sitharaman has been promising to come out with booster measures for the battered real estate sector and the home buyers which are holding the short end of the stick. We are understanding that a lot of SOPs under consideration. We understand, for instance, that the Finance Ministry has asked the Reserve Bank of India's opinion on allowing a one-time restructuring for builders. Right now, real estate is the only sector which is not allowed to have its loans restructured. So it could be a special window. We had seen the UPA announce a similar measure in 2009. This time too, it'll be for projects that are stalled. It'll be up to the banks to decide which are the builders that deserve to have their loans restructured. When we talk about restructuring, it's not going to involve haircuts in all likelihood. It's perhaps going to include moratoriums. You allow a loan to be rolled over and allow the builder to maybe get a fresh loan to finish the project. Last mile funding, you can call it that. As of now, when the builders are unable to meet these conditions, they don't get any such loans. So that could be a one-time exercise for stalled projects and the bank's discretion to take a commercial decision on which of the builders that deserve to have their loans rolled over. Other than that, we are also being told that one of the biggest feedback received from the real estate community has been for a stressed fund. Finance Ministry not very impressed by it, believes the mechanics will be too tough. Also, it will be discretionary in nature. How do you decide which project should be allowed to avail of the stressed fund, in which part of the country and all of that? So that one is looking quite difficult at the moment.
Ganeshram, how are you analyzing the commentary coming in from the top managements in the last couple of weeks? What are you gathering when you interact with the top managements which you cover in your model portfolio or even beyond that? We speak to a lot of them, and very few are actually hopeful. In fact, today, even Titan was on our channel, which otherwise has been doing very well, very confident management, but now is talking soft. What's your thought there?
I think managements have never been more confused actually, and if you ask them for an expectation on outlook, and we generally don't ask managements on how they see the outlook. In fact, we always look at management's commentary as a bit of a lag indicator. Markets need to be ahead, and so we will want to be ahead of management commentary. But just to give you a sense of what they are telling, clearly they are seeing challenges on the ground. Slowdown in consumption, inventory is not being picked up. Festive season is a big hope, but we really don't see on the ground any sign of pickup in demand. So management commentary getting cautious is typically the last sign, and that's clearly because they tell you how things are on the ground. So clearly on the ground things are challenged, so they give us that sense. Their outlook on how they see, it's always hope built in on recovery in the second half and recovery into 20, but that's always we need to be ahead of management commentary.
The way we are targeting internally is that we are going for a 20% growth in the second half in jewelry. This is essentially based on a few things. One is the number of stores which get opened in the second half will be much higher. There's been some delay in the first half, so you will get some additional revenue from that. The second is, of course, the fact that we believe a lot of the jewelry purchases in the first half is getting postponed essentially because of the high gold price. And therefore, it is likely that people will come up when the weddings happen and so on and so forth, which is largely in the third and the fourth quarter. And of course, the festival season and so on. So it looks, we believe it would be a shift in the purchasing pattern because of high gold prices, and people will possibly come back in quarter three because then they can't wait anymore. The event is happening. We did mention earlier that July was bad, as bad as the second half of June. But there has been revival in August for sure. So we've seen some growth for sure. So it's a little encouraging. Of course, we also had our diamond promotion going on now. But importantly, there's been some growth which has come back.
Ganeshram, talk to us about your model portfolio. How is the earnings profile looking 1 year forward, and which are your top overweights right now that you say that still there is time to remain defensive for some time?
So we have been underweight financials, underweight industrials, underweight the government spend dependent companies or sectors. We have been underweight on energy. We have been overweight on staples, overweight on pharma. That was a more recent shift. Equalish weight on IT, where we have dropped weights over the last about 6 months. But more than sectoral preference, we have, looking at more as stock specific. So there are 3 buckets in our model portfolio, and that's how we've always seen it. One is what we call all-weather managements, which are India's best managed companies, time-tested track record of delivering performance across cycles, not just during when the weather is good. It's across all kinds of weather. These companies gain market share, have a strong governance track record, have management depth, and find ways and have the ability to juggle. And if some segment is doing well, some other does well, and so they have some inbuilt shock absorbers which help them do well across cycles. We're looking more for them, and they're costly, obviously, for a reason, and we have not shied away from those stocks, citing valuations as the reason. So we have stayed put with them throughout the last 18 months across sectors, and they have done very well. So these are about a dozen stocks at best. The second pack where we have added weights in the last few months is the other end of the extreme, which is cyclically challenged companies. Stocks are at their bottom quartile valuations. Stocks which are companies where the balance sheet is still good, managements are credible, but growth is impacted, margins are impacted, earnings have got impacted, so the stock's languishing, but these are not structurally challenged companies. These are more cyclically challenged. So we think having at least a 18 to 24 month view, and mind you, that's the way we need to play cycles. Shorter term view is not the way to, because by the time the cycle decisively turns, the stocks are already up. But when the risk reward is very favorable, stocks which are trading at valuations where only about 10-15% of the last 10 days they've traded at these valuations. So we have moved one end of our our model portfolio in two ends, in these two distinct, totally polarized buckets, which we think bodes well, because the first bucket is resilient. The second bucket will underperform, but will have in the tide turns, they are the well-managed companies. They're more quality cyclicals, I can say. In the short term, they will also get impacted. But when you marry the two, the model portfolio tends to behave far better. What we have shied away is the high valuations led or high growth led high valuations companies, and those are mere cyclicals who tend to where market tends to play them for growth, and that growth and multiples are getting impacted, and we have shied away from pretty much that entire space. That be it in could be in cement, in oil and gas, it is also in industrials. So it's pretty much across sectors, NBFCs obviously. So we have shied away from many of them.
Ganeshram, in fact, talking of cycles, clearly auto sector is in the middle of a very kind of a bad phase of the cycle, and there is a lot of commentary coming in from the SIAM annual automobile conference which is happening from Delhi. Let's get a slice of what Tata Motors management has to say.
Stimulus package by the finance minister has ticked the right boxes, but has not turned the needle yet, but it has not hit the market yet. And honestly speaking, a GST reduction to the extent people expect is an attractive gain. Yeah. So lots of people, although they are in a purchasing mode, don't purchase at this point of time, at least don't take what they have ordered, expecting that there's some kind of movement. That's the reason why you heard me saying today, it will certainly help. But if it is for whatever kind of reasons, and that's all to the discretion of the government, it's not possible, then please let us know here and now, loud and clear, that it is not going to come, because we have a joint responsibility to manage the expectations, because even if there's a positive sentiment, as long as we don't manage the expectations, we will not see the turnaround in the current situation of the automotive sector.
Ganeshram, I'm curious to know about your recent change in stance on pharma. How are you analyzing the pharma space? There's a lot of talk about the API opportunities some companies are aiming at exploiting because of the issues in China, specialty API kind of plays. Also, is their pricing environment changing in US? Talk to us about your hypothesis in pharma that you've got it positive now from negative or hold earlier.
Very stock specific. There are many companies still which have challenges, but some companies we believe are seeing two things. One is, it's now almost 6 months, and more decisively the last 3 months, where the US generic drug prices have been stable. And after about close to 24 months of decline, there seems to be some pricing rational behavior coming up in that market. And that's one key reason. The second reason is we think the FDA risks are beginning to moderate. I mean, in some cases it's still there, but managements have woken up and done some repair job on that front. And we don't think if I take another 12-18 month view, the intensity will continue at the same pace. That makes us believe that the worst is over for the sector. But that doesn't mean all stocks are all managements, all companies, are buys. It's not a sector view that we have formed. It's more specific stocks where we think the valuations are interesting, and the companies have cut costs a lot, and that's made when the tide turns on pricing or on the FDA front, the earnings delta can be quite sharp, and that's what we think an upside can have in these specific stocks over the next 18 months. But again, it's not a stock, it's not a bunch of stocks we have picked with the next 3-6 months in mind. It's more FY21 where we think some of these positives can play out.
We'll let you go on that one. Thank you so much for your time. Look forward to having you more frequently from here on to discuss your thoughts on the market. That was Ganeshram Jayaraman from Spark Capital, very well followed in the market, especially for their calls on the broader end of the market. So he was joining us from Chennai.